CELH today is over 10% on my portfolio, and there is at the back of my head a little background telling me that it's time to take profits. But there's also a little Charlie Munger telling me that no, it's a compounder, I should not take profits now, I should let it grow. So today we are going to look at this company, at the stock, and I'm going to tell you what I'm going to do next. Of course, if you had invested in CELH, whether you listen to me or from somewhere else, don't do what I'm going to do today. It's up to you, your situation. So let's try to understand why CELH has recovered so much. It's because of the acquisition of Alani Nu that they recently made. Alani Nu was their main competitor. I'm not going to call Monster or Red Bull their main competitors because CELH, they were operating in the healthy energy drink market. While these two companies, Red Bull and Monster, while they are bigger, they are not really that health conscious. Alani Nu was a health conscious company. Now with CELH, the competition is mostly gone. There are other smaller competitors, but it's not that much compared to what the threat that Alani Nu was posing to CELH. So acquiring a competitor, your main competitor, for a good price, we talk about this, it means that now you can grow at a faster rate that you have been doing in the past years. And the market has also accepted the fact that really the drop in revenues was because of higher inventory by Pepsi. It had nothing to do with the intrinsic company itself, CELH. Of course, the market is going to price CELH differently compared to what it used to do earlier this year or even last year. And the stock of CELH recovered. But if, as a value investor, I calculated the intrinsic value of CELH and you're going to ask me today, is it undervalued? No, it's not. Is it fairly valued? No, it's not. It is overvalued. It is not the most overvalued stock in my portfolio. Number one would be Apple, but I hold only one share. Doesn't matter that much. Number two would be Meta. Meta is 4% of my portfolio, while CELH is 10%. At some point, as you know, Meta was a big portion of my portfolio, but I took profits. So why did I take profits on Meta and today I'm not taking profits on CELH? And even if CELH's stock price keeps going higher, I will probably not take profits. You have to understand something. It's not just about the intrinsic value per share of the company today, it's also about the intrinsic value per share in, let's say, 5 years, 10 years, or even 20 years from now. This is what matters the most. So let's say, as a simple example, a company is trading at $70 a share. The intrinsic value according to your calculation is $100. So a 30% discount. You invested in the company at $70 and you're going to sell at $100 once it reaches its intrinsic value, like Ben Graham teaches us. You have made $30 on $70 invested. That's about 40%, which is good. But what if this company can keep growing its intrinsic value per share every year? Because if you are calculating the intrinsic value, there is no absolute number. It's your way of calculating. You cannot predict far in the future. But let's say this company made a good acquisition. Now they can grow and the margins are going to expand in the future, which is very likely with a company like CELH. The intrinsic value per share can increase, can keep growing over the long term. If you're thinking 5 years from now, let's say every year the company can grow its intrinsic value by 20% a year. 5 years from now, that will be more than double. It doesn't really matter if you bought at 70 or if you bought at 65 or if you bought at 80. Of course, you would want to buy as low as possible to have a margin of safety so that you know if the price is going even lower, you're not losing that much money. But over the long term, if it is a compounder, if it is a company that can keep growing, there is nothing wrong in holding the shares of the company. But if now you're worried about the short term, then maybe it's not for you. That's why I told you don't listen to me. If let's say I'm holding CELH and I worry that maybe it is going to drop by 50% because of market overreaction on the earnings, then it should not be 10% of my portfolio. It's too much. If it drops by 50%, I lose 5% of my portfolio overnight. I don't want that. I'm not talking about me, but for me, that's okay. I have accepted this fact. And I know that if it drops by 50%, I'm going to buy more. Most probably, if the fundamentals do not change. And with a company like CELH, the fundamentals are improving over time. Margins are low compared to companies I usually invest in, but the margins are improving. That's the difference between CELH and Meta. With Meta, over time, the fundamentals are getting worse. The growth of the company is slowing down with all the capital expenditures on AI, which we don't know if it is going to work, on data centers, on metaverse, all these things, nuclear energy. We don't know how much money this capital is going to bring to us, how much cash it's going to generate. The shares are expensive today, according to me, and the buybacks of Meta are not really worth it. So I decided to lower my position. Why not sell everything? Because I still believe in the vision of what Mark Zuckerberg is doing, and I believe it is a compounder. It's not going to be immediate, but I want to put 4%. Worst case scenario, let's say it drops by 50%, I lose 2%. I'm okay with that. But with CELH, I'm willing to bet more. And there is another thing. You can find the whole analysis of CELH on the Superinvestors Club, where I talk about all my investments, all my analysis. There are also investing courses for beginners, even intermediate courses. I'm working on another one. So please, if you want to support this channel, the easiest way is through the Superinvestors Club. There are many different tiers. If maybe $20 a month is too expensive for you, you can pay $3 a month. And if you're in a developing country, you'll be even less. When I calculated the intrinsic value of CELH, if you look at this analysis, you will see that I have been very conservative, as I usually do. So that's another reason why I'm not so worried about it being higher than the intrinsic value. If I was true at 100% that the intrinsic value I calculated was the right one, if there was even such a thing, then I would be worried. But there is no such thing. It's what the market is pricing. Price and value are two different things. You need to understand both value and price. A mistake that many value investors make. They understand value, but they don't understand price. If the market sees that a company can grow earnings, can grow revenues, the market will be willing to put a higher earnings multiples, even sales multiples on such a company, which is happening with CELH today. So the fact that I have been conservative means that now that the stock price is going up, I can be a little more lenient while accepting that it can go down by 50% overnight, and I will be okay with that. I will buy more. What happens now if, let's say, it becomes 15%, 20% of my portfolio? I will be happy, but unfortunately, at that point, if I think that I'm not going to be able to sleep well at night, I will take profits. Maybe not all, gradually, but I will have to take profits. It's all about thinking if you can sleep well at night. When I used to own GameStop during the short squeeze, in the beginning, I was sleeping well, but when it was moving by 10% of my portfolio every night, I was waking up, looking at my phone. I knew I had to sell, and I saw at the peak. And the difference between CELH and GameStop was that GameStop was not a company that was going to grow its intrinsic value. It was a fixed amount. So once you take profits, you have to find something else. With CELH, with Meta, and the mistake I made in the past with Apple selling too early, these companies are compounders. They need little capital to grow. They are growing intrinsic value per share over time. If you find something better, then you sell, you buy the other thing. But it's hard to find something that great. That's why I'm not selling. I said that CELH is one of the most expensive stocks in my portfolio. I believe that the most undervalued one would be Crocs. I recommend you watch this video next. Have a nice day and goodbye.